In this class we're going to talk about manufacturing accounts. A manufacturing business may prepare a manufacturing account as well as the final accounts, such as the profit and loss account and the balance sheet, and they prepare these at the end of the year. Certainly the final accounts, the profit and loss and the balance sheet, are required for statutory reasons, for the payment of taxes, for example. But it's also important for the owners and the managers of the business to understand how the business is doing. What was its performance over the year, say, compared to previous years, to see has it become more efficient or more costly, or are there patterns emerging in its performance. So a manufacturing account is a very useful account for management. Now, the manufacturing account is to calculate the total cost of production. It tries to work out the total cost of production and show how those figures perhaps compare with previous years, as I said before. But they're used essentially for decision-making purposes. The trading and profit and loss account are part, as I said, of the final accounts. The trading and profit and loss account, the trading account will work out the gross profit of the business, and the profit and loss account will work out the refined profit, if you like, the net profit. What did the company make after it paid for all of its various cost elements? And that figure will in turn be added into the balance sheet to give the actual financial position of the business in terms of its capital, the depreciation on its capital, its net profit, so it shows its performance over the year. The balance sheet is the financial picture of the business at a particular moment in time. The balance sheet is on a particular date, let's say on the 31st of December, or on the 5th of April, or whatever date is appropriate. Now, the manufacturing account, well, this is what we're going to deal with here. We're just going to focus in on the manufacturing account and see how it's built up, at least to see what the various components of the manufacturing account could include. So the total cost of production, which is equal to the prime cost, I'll explain that in a second, and the factory overheads. So add the prime costs and the factory overheads to give the total cost of production. The factory overheads would include maintenance on the premises, the rent on the premises, business taxes on the premises perhaps. Look at the various overheads from the various departments, the functional departments, the cost of maintaining the machinery, and so all of the overheads, the factory overheads, will be added in there. Now the prime costs, well, these are the direct materials, the direct labour and direct expenses. So add those together and we get the prime cost. In other words, if the manufacturing company is producing a product, how much does the raw material in the product cost? How much labour was involved in producing the product, and what other direct expenses, perhaps the expenses of machinery, or the cost of running the machinery for that particular product. So what were the prime costs of making the product? The direct materials here is built up from this equation. Direct materials is equal to, and we can just run through it quickly, it says the opening stock of raw materials plus the purchase of raw materials plus the carriage inwards, the cost of moving the raw materials into the business, less any returns, perhaps the goods were faulty or there was a mistake in the ordering, less closing stock of raw materials. Now those are the direct materials, and we'll see how these are built up in the manufacturing account in a few moments. The factory overhead expense, well, these are all of the expenses related to the factory. So the factory overhead expenses are the costs of various departments, the cost of maintenance of the premises, the cost of maintenance perhaps of the machines. There may be functional areas like accountancy, marketing, human resource, perhaps research and development. There may be various departments that in a sense are not producing anything directly. They're producing a service for the business. But they have to be financed, and they have to be financed out of the sale of the product that's been produced. So we can classify those as a type of expense. Now let's look at an example of a manufacturing account, and I'll build it up layer by layer so we can see what we're doing. So let's start by just looking at the stock of raw materials. That's the opening stock of raw materials. That's what's in the stores when we start to look at this account. So that's the stock of raw materials at the start, let's say, of the year. And that's found out from a stock taking exercise. The storekeepers work out what stock of raw materials, semi-finished goods, and what's in the stores. That's the value of the items in the stores. We add in the purchase of raw materials over the year, so we'd add in that. We'd have to add the carriage inwards, the cost of moving the goods into the company, pay for the transport costs. So we add that. And we get a total figure when we do this of 17,232. So that's the total cost of our raw materials. Now we'd have to allow for any returns. Perhaps the orders were wrong, or perhaps some of the components received were faulty, or the raw materials was not good quality. So we'd return those, take away 1,156, which leaves us the amount we actually used of 16,076. So we'd also have to take away any drawings. Now drawings would be perhaps the company takes out some raw materials for some other purpose, or just simply takes them out of the company. It could be the owners of the company just take some of the items for their own personal use. But these are drawings. They have to be shown in the accounts. Otherwise, they could be classified as stolen property. So they have to be classified and have to be accounted for. So sometimes items that have been received into the stores are used for other purposes. So we have to take them out, call them drawings, which gives us the net sum of the raw materials used as 13,892. Now take away the closing stock. In this case, the closing stock, the storekeepers report it's 391. Now compare that with the opening stock of 3,189, right at the very top. You'll see that in this case there's a lot less items held. There are a lot less items held in the store, and that could be down to the efficiency of the store's management, or to the efficiency of the various managers who order the items or set up the production lines. Or it's generally speaking, it's held to be a good thing, because items held in stock are really dead items. They're just an overhead. Raw materials sitting in the stores are just an expense. It's only when they're used that they become useful. Only when they're used they start to make a contribution to the business. They get converted into the final item which can be sold. But before that, they're just simply lying around in the stores as an expense. So the cost of direct raw materials then is 13,501. So that's what we've used over the course of the year. So now we know what the direct raw materials cost. Add in the direct labor, if we can work that out, how many people were involved, what was the cost of the people who were working directly with the raw materials to make this particular product. Let's say it's 11,762. Add in direct expenses. Perhaps the company has to pay a royalty for each one it produces, add in the direct expenses, perhaps in the form of electricity that was used as well, or what exactly goes to make the product, what contributes directly to make the product, which gives us our prime cost, which is 34,044. So now we've added up the costs of the direct raw materials, the direct labour and the direct expenses, which gives us our prime costs, which is what we met in the previous slides. Add in the factory overhead expenses. Well, I won't go through them individually, but you can see factory lighting, factory heating, factory insurance, rent, maintenance, indirect wages, supervisors' wages, and so on and so on. Add it all up, and we'll say it comes to 54,144. Add that to the cost of making the product, the prime cost. So we now add in the overhead expenses and the prime costs, and we get 88,158. So we're adding the 34,044 to the 54,114, giving us a total of 88,158. Add in the opening stock of work in progress. Sometimes there are items that have been semi-finished, items that have had some work put into them and not completed, so we have to add in the opening stock of that. And that gives us 130,000, I beg your pardon, 130,373. Less the closing stock, what we've got left in the stores that have been completed but not sold yet. That's the closing stock. So the cost of production is 113,530. And that's how we get a manufacturing account. Now we can see from the account where expenses were incurred in terms of raw materials, direct labour, the factory expenses, the overhead expenses, and we've worked out what the costs are, the production costs. And that's how a manufacturing account is built up. Now, manufacturing accounts. Well, in a manufacturing concern, there are usually three types of stock. Stocks of raw materials. These are the materials that are used for the production of the item. The stock of work in progress, materials on which some work process have been completed. So some work has been done on the raw materials, but they're not finished. They're just work in progress. And the stock of finished goods. These are the materials on which all of the production processes are completed and they're ready for sale to the customers. So we have three types of stocks: raw materials, work in progress, and finished goods. Now, the format of a trading account for a manufacturing concern. Well, in this case, let's look at the sale of finished goods as 72,682. Less returns inwards, so we have to take away what has come back. So we get a net figure of 64,548. That's the sale of finished goods. That's what we've actually sold. Less production costs of goods sold, so the opening stock. Add in the cost of production, which comes to 90,366. When we add in the opening stock plus the cost of production, less the closing stock, whatever is left in the stores, giving us 63,855 in this case, less finished goods drawings by the owners. So the owners might take away some of the items themselves, in a sense just book them out to their own name. Of course that constitutes a part of their drawings and they will pay tax on that, but it's come out of stock, so we need to account for it. So let's say the owners have taken away 1,682. So it gives us a net figure of 62,173. Now, if we have the sales figure at 64,548 above, and the less the finished goods drawings and the total cost of production at 62,173, subtract one from the other, and we get the gross profit or the gross loss. It depends on how the figure comes out. In this case, it's a gross profit. The sales, 64,548, is greater than the costs, 62,173. So there is a gross profit. So we can use the manufacturing accounts to work out the gross profit of the business. Now, fixed expenses and variable expenses. Well, some expenses remain constant whether the level of activity increases or falls. These expenses are called fixed expenses. For example, the rent of buildings. Once the company has rented a building, it doesn't matter if it produces a lot or very little. It's still the same amount has to be paid in rent. So it's a fixed charge. These expenses are called fixed expenses, as I said, but the expenses which change with changes in activity are called variable expenses. For example, the costs of raw materials. So we have fixed and variable expenses. Now, there's one last slide which may look slightly intimidating, and it's called key points. So it does sound like something we should know about, but in fact this is really only necessary if we're going to draw up a detailed manufacturing account or a detailed profit and loss account. So I've put it all onto one slide. I'm not clicking it in one at a time like I normally do. In this case I'm just presenting it all, and because these are just procedures to follow. For example, point 1, carriage on raw materials means carriage inwards, and it is a part of prime costs. So it's worth noting. So if you're doing an account in practice, you should go through each one of these to see where each part is assigned. Carriage outwards is shown in the profit and loss account as an expense. Well, it makes sense. It's outwards, it's carriage outwards, it's going out, so it's an expense. Royalties paid is to be treated as a direct expense because they have to be paid. So just go through each one. I'm not going to click through these because they are fairly straightforward and they are more procedural, if anything. So it's necessary just to know where each part goes through. So go through each one if asked to prepare a manufacturing account, just to see where each item should be allocated. So that's all we're going to deal with here. I'm going to leave it at that and say thank you for watching.